Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, March 11th, 2024. Hope everyone had a great weekend. So, as always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So, today's key macro event is BOJ tightening versus PBOC easing. So, the nuance there is the Japanese yen and 10-year JGB yield continue to advance amid increased speculation that the Bank of Japan is ready to exit negative interest rate policy soon. Elsewhere, the February CPI and PPI data out of the Chinese economy were well shy of official targets. Specifically, the 3% CPI target for 2024 looks rather aggressive considering these data. In terms of market implications, on Friday, Japan's largest labor union announces the results of its annual wage negotiations. That catalyst will go a long way towards determining whether the BOJ hikes its benchmark policy rate for the first time since 2007 at its March 18th to 19th meeting or at its April 25th to 26th meeting. Elsewhere, the lack of on-target inflation in the Chinese economy supports our call for Chinese authorities to continue supplying liquidity over the medium term. Transitioning to my 42 macro dashboard here. So getting a oversold signal here in the U.S. dollar, that's typically a negative sign for risk. Consider that to be similar to a oversold signal in the VIX. Our credit spreads, we're getting a near oversold signal here on the 2-year nominal Treasury yield, not quite there yet, which means a near overbought signal in the bond prices. And then Ethereum continues to be hug the upper boundary of its range, but again, that's really not a signal there in the context of the raging bullish price momentum. As always, we'll wrap up with a question from our community here. Just reading question titled MSR. MSR, for those who are not familiar, is our macro scouting report. So that's our monthly deep dive presentation where we help investors, across the investment spectrum, really understand the full distribution of probable economic and policy outcomes. We don't just put out presentations that say, here's what Darius thinks. We help investors understand what that full distribution of outcomes is so that when the market regime does change, we are all, the folks on Team 42, the folks in our community, are very much aware of the things that are causing the regime change and how long market regime change is likely to persist. And so that's how we prep them for that every month in these deep dive scatter reports. So going back to the question here, reads, I signed up when you started 42 Macro and immediately strayed. I've come back to see your improved processes. I must say this is one of the best balanced and most balanced and data-driven presentations I've ever seen, not only from you, but from various other sources I followed. Bravo. So just thank you for that really kind compliment. We worked very hard over the past 3 years to improve our research process. And more importantly, just as importantly, improve my communication of our research processes. To my knowledge, we are the only firm that tries to sell high-end macro risk management content that we use to prepare our institutional investors for factor rotations to the RA and retail investor channels. And we're very proud of that because we are truly democratizing the kind of high-end macro risk management information that you need to stay on the right side of market risk. So getting to the question there, the question is about consumer balance sheets. Aren't they heavily skewed to the wealthy? And if so, do we care in terms of overall consumer spending? So the question about that. So just unpacking that. So I think I understand where this question is coming from. I've seen a tremendous amount of terrible research, if for lack of a better word, about the low-income consumers being tapped out, about what it called the so-called Wall Street so-called excess savings being tapped out as well. And both of those analyses were just flat out wrong. We're not going to see anyone take any accountability on that kind of research, but we're going to hold them to account because that's the kind of bear porn research that has cost trillions and trillions of, millions of investors to get squeezed in trillions of dollars worth of shorts over the past, let's call it 12 to 15 months, because they're focused on things like, oh, the low-income consumers tapped out or excess savings are running dry. Both of those statements are very wrong, and they continue to be proven wrong by the data. So just answering those questions with respect to consumer balance sheets, yes, they are over-indexed to the rich. The rich spend the most money in the economy by a factor of 2 to 1 when you break it down into quantiles, and they obviously have the largest stock of savings. Whether you look at some of the distributional aspects of the savings of the wealth data that we have in the economy. So the reality is we can't exclude rich people from aggregate statistics about the economy, about the growth, about income, about employment, about all this other stuff that drives economic activity, that ultimately drives corporate profits, which ultimately drives things like the stock market and the credit market. So I think it's very important that we are doing research from a non-biased balanced perspective. And that's something that we offer our clients on a daily basis, 6 times a week here at 42 Macro. So again, thanks again for the kind compliment. It's as well deserved, it's well earned. Our teams are working very hard to, kind of improve our processes, improve our models. And I've certainly been working very hard to improve my communication of the output of those frameworks. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Monday, March 11th, 2024. Everyone have a wonderful day. Best of luck out there. Have a great week. And we will catch you back here tomorrow. Cheers.